Hello and welcome to the Capital Exchange. I'm Travis Porwood, the Chief Investment Officer with Allen Capital Group. And today we thought we'd change things up a little bit and do a short video over key themes we see driving the market currently. Right at the center of all the key themes is AI, or artificial intelligence. You've all heard about it, or you're all hearing about it, how it's affecting your daily lives. So let's talk about how it's actually affecting markets as well. First, company earnings, right? Over the long term, company prices or company returns generally follow earnings. Earnings grow, company prices grow, and investors realize those returns. So AI, if companies are using it correctly, can use it to expand their margins. Okay, they can become more efficient, they can become more productive, or the workers can become more productive. And if they do that, it should be able to enhance profitability for the companies who can implement it correctly and either defend their market share or expand their market share here moving forward. On the other side of that coin, though, is disruption. As AI evolves, some companies are going to be vulnerable to its advances, and they're either going to disrupt their business model and make them have to defend it or change it, or some companies are just going to go away altogether because the product they had wasn't really defensible versus AI. A lot of the volatility you're seeing in markets right now is just that, markets wrestling with how AI is going to affect either company profitability or company disruption in various areas of the market. So that's the first way, company earnings. Second way we see AI affecting market is fixed income. As companies build out their AI infrastructure, and you've seen this on the news, we're talking about data centers and different components to actually support these AI models. The debt load for a lot of these companies is going to increase. They're going to issue debt to help fund these projects with the hope that in the future they pay off and increase profitability down the line, right? As some of these companies issue more debt, they're going to become larger debt issuers, which means they're going to become larger components of the bond market, right? So, for example, if you own a passive bond ETF and that just simply buys the bonds that are available out there, and the heaviest weights in those indexes or in those ETFs or mutual funds is going to be the companies that issue the most debt, right? So as these companies, and let's talk about the hyperscalers that are building out a lot of these data centers, your Metas, your Amazons, your Oracles, as they take on debt to build out more of this AI infrastructure, if they're going to become larger components of these passive indexes, right? So your exposure to those particular companies is going to increase. Now, I'm not saying that's good or bad right now, but I'm saying it's something to be aware of and keep your eye on, because we could fundamentally see a change in bond market structure here as the build out of AI progresses, right? And some of these companies or some of these areas of the markets, as they continue to take on debt, investors are going to start to demand higher interest rates from those companies until they've proven that AI infrastructure, that AI investment can pay off. So that's going to increase their borrowing costs, perhaps crimp their productivity. Again, something to keep an eye on here as this story progresses. Next, we'll talk about market sentiment. Market sentiment right now, as AI kind of became or spread like wildfire here through markets, investors flocked to the companies they thought were going to benefit the most. And again, we're back to your hyperscalers when you think about it. Your Metas, your Googles, your Amazons, better known if you turn on your TV as the Super 7 or the Magnificent 7. As investors flocked to those particular companies, their values grew, they became larger components of the equity indexes, right? And as they became bigger, we saw the equity indexes or the stock market indexes, we'll just use the S&P 500 as an example here, become more top heavy, right? A larger portion of the value of the S&P 500 is in the top 10 stocks in the S&P 500. And a lot of the returns we've seen over the past few years have been driven by those top 10 stocks or those Magnificent 7 stocks that you're hearing about on the news. Another side of market sentiment here, again, is if we're talking about disruption again, software companies. Markets are trying to sort out which software companies are actually going to be enhanced by the rise of AI and which ones are actually going to be disrupted and go away. So we've seen what's been called the software apocalypse here recently, where pure software companies, which markets had generally regarded as good businesses, cash flowing, asset light businesses, have been punished as markets sort out who the winners are and who the losers are there. Because there will be winners, there will be losers, and there will be bargains out there right now. Some companies that have been punished that are going to survive and actually thrive in the environment moving forward. Now, people who are invested in the Super 7 or the Magnificent 7 and saw their net worth increase or their portfolios increase, they certainly enjoyed that. The ones who didn't, the ones who perhaps missed the party, they might have a little bit of FOMO right now, or fear of missing out, which might make them chase returns or jump into companies or stretch their risk profile or risk thresholds further than they should without staying disciplined, right? You shouldn't chase news headlines and you shouldn't chase stocks that are just going up because you see them going up. Again, all your portfolio or your portfolio construction should be grounded in your plan, what you're trying to achieve, and it should be specific to you, not to what your neighbor's doing. So keep that in as I see FOMO gripping the markets here. Next, we can't really talk about key themes without talking about monetary policy. So monetary policy is largely is the Fed adjusting interest rates according to how they see inflation evolving and how they see the employment picture evolving right now. Now, with AI, is that going to make companies more efficient and lower their costs here moving forward? And are we going to see inflation decrease with that? That's, what markets are wrestling with in terms of how AI is affecting that and the future path for inflation. If inflation moderates, we might be able to see the Fed cut rates, which the markets would enjoy. If it remains sticky and as we've seen, that last mile has kind of been hard to wring out of inflation right now. Rates might be higher for longer, and if they're higher for longer, markets are trying to sort out the inflation picture and how that's going to affect interest rates. And that's why you're seeing some interest rate volatility here as markets work through that, what's going to happen with inflation expectations. Next, geopolitics is always a key theme driving the markets. We've seen, if we're talking about AI specifically here and coming out of the COVID era, we've seen companies or governments looking to onshore a lot of their AI build out. They want that to be within their borders so they can control it and not be dependent on other nations during times of stress or times of chaos. And they want to be able to stay in control of that. Now, that onshoring and that race, that AI arms race I'm talking about, is going to create rivalries amongst countries in terms of how that build out progresses, who's going to have the better models, how they're going to implement AI in the future. We're already hearing about that between us and China. You're going to continue to hear about that as this story progresses. Another way to think about AI in terms of how the government's using it or how companies are using it, are we being surveilled? Are companies using our data? Sure they are. And are governments using it to surveil us? I'm sure they are to a certain extent, maybe more than we know right now, but it's probably making it easier for them to do that, something to keep in mind. And then military transformation. How is AI transforming military operations? We've heard stories in the news with some recent operations out there on how AI is being used to be more efficient, to be more precise in those operations. Again, affecting the geopolitical world quite a bit here as this story unfolds. Next, we'll talk about private markets. Private markets have steadily rose to prominence here over the past several years. Markets and investing in private markets. A lot of the AI build out that we're talking about, data centers and in various areas, private credit has funded that, right? Investors have gone into private credit funds or direct deals to fund a lot of this build out. So AI again is pulling more money into private credit. And if you dig a little deeper into that, is private credit has funded some of those software initiatives or software companies as well. And if that's the case, which software companies are going to survive? Is private credit in trouble because of its exposure to software? Well, the answer to that is it just depends on the fund or it depends on the deal you're in. Not all private credit is invested in software. Private credit is actually very specific. You can get into very specific areas of it right now. But in the headlines and in the news, again, markets are wrestling with the uncertainty there. So you're seeing a lot of stories breaking or evolving there about private credit and what are the implications of AI and again, the software apocalypse. And then venture capital funding, right? So what industries are going to evolve as AI continues to evolve itself, or what industries are going to spring up? How are those industries being funded? And a lot of that's coming through the venture capital channels here, as well as new technologies are coming to the pass. So, again, company earnings, fixed income, monetary policy, market sentiment, geopolitics, and private markets all being affected by AI. And then a fog hanging over all of these key themes, again, is the Iran war, right? It's really driving the momentum we're seeing in markets here day to day. And in some of these day to day moves we're seeing as the news comes out of the Gulf over there or comes out of Iran with what's happening here, because the Iran war has implications for all the key themes we're seeing here. On company earnings, are the inputs going to get more expensive? Which on interest rates, is fixed income going to become more cumbersome for companies? On market sentiment, how is the war going to evolve? How long is it going to last? On monetary policy with inflation, is if oil prices are higher and material prices are higher because of the war, inflation going to be higher again? And that's going to bleed into interest rates. Geopolitics, I think that the Iran war speaks for itself there. And then on private markets, again, as it's affected by all the factors we discussed here. So hope you all enjoyed this change up. And again, all these things to keep in mind as the stories of the markets evolve here. Thanks, and we will see you next time.